This is Gina Domanig, a pioneer in clean tech venture capital from Emerald Technology Ventures. Do you want to sit here?
Sure.
And I sit here. I hold it for you. I'm your water manager, okay? Whenever you need it, I give it to you.
Excellent, thank you.
Okay. When, why, and how did you end up becoming a clean tech venture capitalist?
The when is easy. That was back in 2000 when I was actually approached by a headhunter to join Sustainable Asset Management at the time to start up the venture capital activities. And the why I chose that opportunity, probably because at the time it seemed like it was very multi-dimensional. There was technology, there's industrial applications, there's the finance aspect, transaction aspect, of course the people aspect of it, and that was very attractive. I would say I still agree that it's very multifaceted, and that's probably also the challenge.
And now, 14 years later, do you think it was a good idea to become a clean tech VC?
Ask my husband. No, I think, yeah, it's definitely a career which is extremely exciting. It really grabs you and sucks you in. But of course, not everybody wants that kind of a career, and some people are very strict about what their limits are. Having their private lives completely separate from their business life. I think that's not realistic in venture capital. You have to be available, and it's a very flexible job, but it also means that you're always on.
What does it mean on a daily basis for you to be a VC? Give us a little idea about what you do during 1 week, a normal week, which is a little bit crazy, not too crazy.
A normal week I travel, so I travel almost every single week. I live fairly close to the airport, which is convenient. But I would say about half of my time I spend with the portfolio companies, and the other half, it's a mixture between investors, looking at new deals, of course, and the overall management.
And what are typical problems you are solving with the portfolio companies?
Opportunities, right? I think, in today's environment, and you said it earlier, the VCs have to be very much involved in securing the ongoing financing of the portfolio companies, much more so. I mean, back in 2000, there was hardly anyone in the space. It was difficult back then. Then in around 2005, 2006, there was a lot more money. You could kind of leave the companies on their own to raise their own money. I think in today's environment, they really do need the help of the existing investors. That, of course, hiring talent, but especially in our case, it's very much helping them make the connections with the large incumbent corporates who will then either be customers of them or alliance partners.
Yeah, so we talk about the corporates a little bit later. They are one of your specialty. You are famous for having many corporate relationships, and I think you are still open to even more new corporate relationships. But let's get a couple of facts. How much money do you have under management, and how many funds did you raise, and how easy was it to raise the last fund?
Okay, so since 2000, we've raised 3 funds, and we've managed 2 mandates. In total, that was about 370 million euros, so about $500 million. Just to give people kind of some bookmarks or bookends, the first fund in 2000, first-time fund, first-time team in a sector that doesn't exist, and we raised 100 million euro, which I think we should have appreciated at the time what a miracle that actually was. Yeah. In 2006, we raised 150 million, and in this last fund, we raised almost 70 million euro.
And you closed it in 2013? Or
no, we closed it earlier this year, but there were some stragglers, as usual, with the corporates. They're always a little bit late, so.
Who are your LPs, your limited partners, and how do you cooperate with them? Are they really adding value or only give you the money?
I think when we first started our business in 2000, we very much looked at our portfolio companies as our customer. And I think particularly the environment in the last few years has kind of helped us turn our heads around and realize that the investors are our customers. The portfolio companies are the product or service that we're delivering. The returns and not just financial
the
returns.
innovation that the corporates are really interested
So
in,
it's
right?
financial return and strategic return, exactly, the corporates. So who are our corporates? It goes from JSR in Tokyo, SK Group in Korea, into Europe. There's Mahle, Evonik, ABB, Sulzer, Clariant, Sibelco, and then in North America, Ecolab and Suncor. And there's a couple of family office types as well, but you're right, the majority are corporates. And the value that they want from us, and that we've really had to get extremely good and hone our strategy as far as what value we bring to our customers, is open innovation. And just the exact same thing that we preach to our portfolio companies, that understand who your target market is, make sure that you have a very compelling value proposition to them. We've had to get really, really good at that, and it's particularly in the last couple of years.
And you are not only matching your portfolio and your LPs, but sometimes just a startup knocking at your door, you ultimately decide not to invest, but you can still make an introduction.
Definitely.
Because you are an open innovation channel for the corporate, right?
Definitely. And often it's not only our LPs. So even in the process of doing due diligence, we will start to introduce companies to corporates who, obviously, those who are our LPs are the easiest, but also to other corporates. We know that there might be a mutual benefit for them getting to know each other, so that even if we don't decide to invest, it wasn't a net negative for the startup company.
And do you have this cooperation with the corporates all automated with a wonderful extranet and they can check it all online, or do you really have to spend a lot of time face to face? Because some VCs tell me, well, I have to spend too much time with the corporates. They always call me, I have no time to do any productive work.
It's both. Obviously automate where you can. And I think, obviously, we need to be very careful and respect the confidentiality of the startup company, so we don't just make their information available to our LPs. But some of the information is public information. We can make that available. We try to automate that. But we do spend a lot of time. Each month, we have at least one scheduled call with the LPs to discuss deals that they're interested in, companies they're interested in. We have at least one workshop a year. And part of my big travel schedule is, yes, we visit our LPs at least once a year.
Once a year. And do you get a lot of deal flow via the corporates, or is this really an innovation one-way relationship and they are really not so proactive?
I would say we get maybe 10, 15% from them.
Okay.
So we get about 1,000 business plans a year, and maybe 100 of them come from those guys.
And there are corporates who have a corporate venture capital activity, and there are ones who still not have it, but the number of the CVCs, the corporate VCs, is increasing. Do you notice an improvement about more expertise on the corporate side that helps you being a VC? Or on the other hand, are they becoming competitors even?
Well, first of all, I think, and Renee mentioned it before, we all syndicate, so we're happy if more people are coming into the sector with money, because we're definitely not in a situation today where we compete against each other. We're more desperately making sure that we continue to exist and that there's enough capital available. So I think it's a very, very collaborative approach. The corporates do play a much bigger role today than they did in the past. We're glad that they come with capital. I do think, though, that there are, certain, it's nice as a corporate VC, you don't have to raise money, but then you're at the whim of corporate changes and strategy changes. And there still is, compared to independent VCs, there's a very high turnover within the corporate VCs. And that's difficult because, I've been doing this for almost 15 years. I'm still learning every single week. And if you're constantly removing the people from the corporate VC every 2 to 3 years, they just start to go up the learning curve and then they're gone and somebody new comes in. So I think that's a challenge.
Yeah. I just remember there's a famous VC in the States. He's called Brett Feld, a guy writing really cool books like Venture Deals. And he recently blogged about a CEO being a learning machine. Aren't you a learning machine too, as a VC?
Yeah. Oh, definitely. And that's one of the exciting things about the job, is because you're learning every single day, and you're meeting with these startup companies who their one goal is to get as much of information and understanding about their business into my brain during that 2-hour period that we're having a discussion. So it's exciting. It is. It's very exciting. But it is challenging as well, because, as you know, in whether you call it clean tech or industrial applications, whatever it's called today, it's very, very broad. There are different technologies, application areas, different business models, different industry dynamics. So it's a lot to learn.
Now I want to talk about your investment strategy. How much did you change the investment strategy and adapt it to reality over the free funds? And what is your current preferred investment you would like to make?
I think in our very first fund in 2000, we were a bit naive about the length of the technology proving cycles and the length of the sales cycles. So we've gotten a lot more realistic about just simply how long that takes. And so obviously we've had to, I wouldn't say move away from early stage, because there are a lot of very early stage companies that happen to be in businesses or industries where the sales cycle is shorter or the technology proving cycle is shorter. So I would say that we haven't gone away from early stage investing, but we've tried to avoid those that have those typical very long cycles. So that has changed. Clearly, in this last fund, we've had to adapt our strategy because there is an incredible lack of money in the industry. Our fund is smaller. Almost everybody else's fund is smaller. There are a lot less funds around. So we have to be much, much more careful about the amount of cash that's actually needed to bring a company to cash flow break even. Because if the exit doesn't happen when we all want it to happen, the truth is the company should survive. And the worst thing that can happen is that they actually run out of money.
So the name of the game is capital efficiency. The total amount of money is nowadays less per company over the lifetime than you dedicated in the past, I would believe,
or
right?
we come in later, or we simply come into a company that maybe needs 30 million to get to cash flow break even, but we come in after 20 has already been invested, and then we syndicate with others the remaining 10. So in that case, I mean, of our last 2 deals that we've done, one was a very, very early stage company in Finland, where MetGen, exactly. And the other one, which we will announce actually next Tuesday, but it already closed, is called Geodigital in Canada, and that's a rather late stage company. So it's already in revenues of 30+ million.
Wow. And so these are the 2 recent deals. Did you do any other deals during the last 12 months? Or?
Nope. Those are the 2.
So new investment activity per year is also going down, meaning that you have to do a lot of follow-on and you do less new deals?
I think it was more of a distraction because of fundraising.
Okay. Yeah.
So we definitely will do more deals per annum in the next couple of years. We have to. And there's a lot of companies that are kind of in the pipeline, but the partners have spent, well, not just the partners, everybody in the team has spent a lot of time on fundraising, and it has distracted from, I wouldn't say our core business, but maybe the part of the business that we like doing more.
Yeah, you like to spend the money more than collecting it. Yeah, so what makes an investment a smart investment? How do you think about an investment? What are the key things you want to see in a startup that make you comfortable of making a smart decision? Because you can only know many years afterwards if it was a smart decision, but you have this great expectation about a brilliant future.
Yeah, I mean, we only really know if it was a smart investment once we've returned the capital to our LPs. But I think our strategy is that we're still very technology focused, so we're always looking for companies that have a very strong competitive advantage, typically based on IP, whether that's patents or know-how, it doesn't matter, but that simply is kind of who we are in the market. So the very strong value proposition, obviously a growing, attractive market, those are all, let's say, standard. What's important, as you mentioned earlier today, is the people. So it's the market, it's the product, it's the people. And as I mentioned before, more and more in our investment strategy today is the consideration about capital. Where's the capital going to come from? Do we know? Ideally, we syndicate a deal when we go in that we believe is going to take the company to cash flow break even.
Yeah, right from the beginning you syndicate.
Definitely, we almost always syndicate right from the beginning, but it's the amount of money that we're looking to syndicate now that we just can't count, even our very, very close friends within the industry, we can't count on them being around, and unfortunately they can't count on us like it used to be kind of understood that, yeah, you're a good VC, we've worked together before, no problem, you're going to be around. You can't even say that about the corporates, because even though the corporate will be around, you don't know if their VC team will be there. So the amount of capital is definitely a big factor in our investment decisions.
So basically, when you make your first investment, you already have an idea how much money this company needs, and you have to agree on a joint strategy together with the founders, right? And the co-investors. This is the way we would like to develop this company.
And
is it easy or difficult to come to such a common strategy?
It's really easy before you've sent them your check.
Yeah.
Everybody agrees to everything while you're still in the due diligence phase, right? I think the hard thing is afterwards, once the CEO receives the money, and then particularly if you do follow-on rounds, new investors come in, they kind of extend the horizon further. They are more open to the company ramping up their cost structure. And this is really, really key is, raising capital. It's not always because you want to invest in a huge plant. It's to fund your losses, right? So if we can make sure that our portfolio companies keep their cash flow break-even point at a revenue run rate of, let's say, 10 million a year, it's much more realistic to think that we can collect enough money amongst us to bring a company like that to a successful exit. The problem is when they start to ramp their cost structure and then all of a sudden you wake up one day and you realize, geez, they need to have a revenue run rate of 30, 40 million euro a year, and that's very difficult.
How many of your portfolio companies are developing according to plan? In reality?
None.
I
mean, but you
are you good at improvisation?
You can't be even mad at them. The individuals who choose to be an entrepreneur are by nature overly optimistic. Yeah. They don't think that, as I always say, shit happens all the time, right? And they don't think that that's going to happen. And that's why they leave their perhaps more comfortable jobs or more secure jobs and decide to be an entrepreneur. So we need to understand that that's the nature of the individual that we're working with. We are also a bit overly optimistic, otherwise we wouldn't be doing what we're doing as well. And then we just need to prepare for things to go not according to plan.
Does it help sometimes to bring in a more professional, experienced CEO? Or do you prefer making a learning machine CEO kind of guy or lady to be a really successful one?
We deal in the industrial sector, so it's extremely helpful to have people in the senior management team who have the connections, who have the experience. That's clear. But what is very difficult to replace is the passion of the founder and of the entrepreneur. A lot of these men and women, they will either be successful or die trying. And that's a fantastic, let's say, character to have in charge of your investment, right? To have somebody who's just not going to let it fail. If you hire somebody, they come in, they say, these decisions were made before me, the problem started before I got here. So you can have a little bit of that kind of disconnecting with the past of the company and not feeling the responsibility to ensure that it's a success. So ideally, you can keep the founder in there, but make sure that it's somebody who will bring in other people around him. Maybe even he'll move into a CTO position and bring in a CEO. But in any case, that there's a C-level team there that has the passion and the feeling of responsibility of the original founder, but also the industry experience.
I very much believe in sharing the responsibility, but also the upside among everybody in the startup. So how many of your portfolio companies do have a good and a fair options program in place? And do you make it a requirement before you invest to have such a thing?
That's a requirement. Absolute minimum is that they should have 10%.
10% options
Obviously, I'm not a big fan of just topping them up. You know, if they completely blow their budget and they have to raise more money, they're not going to get compensated for it every time. That's not fair. My original investment gets diluted. They should be diluted as well. But we can't survive in a situation where the management team doesn't have a very, very strong financial incentive to make it a success for us as well.
I know many German startups who don't have option program.
Yeah.
Do you have a similar experience? Is this a cultural thing?
Yeah.
Maybe?
Yeah, it is a cultural thing.
In America, it's standard, we know that, but
yeah,
here in Europe.
In the US, Canada, in Israel, in a lot of countries, it's absolutely standard. I think it's short-sighted. It's also you find more on the continent, people who don't want to share. Well, it was my original idea, why should I share? And we simply make it a requirement, and I'm usually the head of the comp committee in most of my portfolio companies, so I have an ability to kind of force it through. But if they don't have a proper incentive system in place, when we start to look at the deal, we will simply make it a requirement, and it becomes part of the entire transaction that option pool is created. And at very, very low strike prices as well. Obviously, they're coming in, they're getting common shares, we're getting preferred shares, we've got liquidation preferences, they don't. So obviously, their strike price is much, much lower than ours.
Yeah. Okay, a final question I have, and then we open to 2 or 3 questions for the audience. And this is not about collecting money, but returning money to the LPs. And the key topic of fund performance. What can you tell us about your fund and how is it performing or has been performing in the past?
So we have 3 funds. I can say our first fund is almost fully liquidated or realized, but not completely. We still have 3 investments. The fund performance is positive.
Okay.
Is positive and will be positive at the end. Fund 2, it's too early to say. It's especially with, if you think it's a 2006 vintage, we had the whole financial crisis. So what we were lucky to have in the first fund was early exits, really healthy IPO markets, which we did some early IPOs in our first fund, which was great. In our second fund, obviously the IPO markets were closed for a long time, and still to a large extent, it's not possible to do an IPO like we did some years back. But I think the health of the Fund 2 portfolio companies from a self-financing cash flow break-even point of view is very strong, so that you can afford to wait in most of those companies until the right exit opportunity comes.
And can you translate a positive performance of the first fund into something like an IRR? I know that many people write in their PPM documents, we are top quartile, 20%, yeah, let's do it. I think that's probably a little bit different in reality, right?
Yeah, I mean, it has to be positive. I think if you don't have a positive IRR, it's very, very difficult to raise money.
Yeah.
But I'm not going to give you the number now.
Okay. Okay. We try it later again with a little bit more wine.
Without the TVs on.
and no public audience. Now we open for you. If you have a question for Gina, please raise your hand and wait for a microphone.
So, but still, I got to. Actually, you mentioned the scarcity of capital in the sector, and do you have any experience of co-investments or working with other institutional investors in your portfolio companies? And the second question is, at what stage do you find valuation discussions with the founders more difficult? It's the seeds when they come to you with an idea, when it's a seed stage, or when you have to deal with more mature guys at the early or late stage? Thank you.
Yeah, the first question as far as experience with co-investors, you mentioned institutional investors, but we have experience dealing with all kinds of co-investors.
How many in total? Can you count them? Or give an estimate? Hundreds of co-investors.
We've made 50 investments, and there's at least 2 co-investors on average per company. So yeah. It's well over 100.
Wow.
You never really know whether a co-investor is a good co-investor unless you've been through difficult times together, right?
Yes.
So we have a lot of experience working with corporates, working, either LPs that are co-investing with us, working with other VCs, a lot of them in the room. Yes, I mean, we always try to co-invest, we always try to syndicate, and I think that's the nice thing about the industry is that everybody is, I think, extremely collaborative. And everybody's really looking out for each other, helping each other out.
And they have to be, right?
Yeah, we
There's
need the other funds also to be successful in their fundraising.
Yeah.
Otherwise, we're going to have very poor performance if we can't find enough capital for our portfolio companies.
Yeah.
And the second question was on valuation. I think it's gotten easier with the really early stage deals because I think particularly if the entrepreneur has been talking to a lot of people, then they realize that it's very difficult and they have to be realistic and they have to come down a bit in what they were perhaps fantasizing or could have been fantasizing back in 2005, 2006. But I think the later stage they are, the more difficult, because they will pull one reference of, oh, well, this company exited at 10 times revenue. Yeah, but you know what? That's not the industry average. That's more difficult. And so there still are every so often the cases where we get a very late stage deal. They believe that that they're going to be the one industry example of exiting at 10 times revenue. Okay, so we just pass,
Yeah.
And they can come back if they want to be more realistic. They can come back to us where we don't hold grudges.
Okay. All right. A final question from you guys, or we wrap it up. Okay. I hope that you have learned a little bit how it feels to be a smart green VC. We want to thank Gina very much for coming on stage and sharing the time. And I understand you will be here the whole day?
Yeah, I'll be here until noon tomorrow.
Until noon tomorrow, okay. So you have a lot of time to spend with Gina. Do all the pitches you can.
Yep,
and let's have a coffee break for half an hour now. Thank you.
Thank you.
Wonderful.
Thank you.
Thank you very much.